Most people spend their entire lives working hard, earning money, and yet somehow arriving at retirement with almost nothing to show for it. They follow the rules, go to school, get a job, pay the bills, and still feel financially stuck. So what's the difference between someone who builds real, lasting wealth and someone who simply survives paycheck to paycheck? It's not luck, it's not even talent, it's a formula. And once someone understands it clearly, everything changes. The mindset that separates the wealthy from everyone else. Before getting into numbers and strategies, there is one thing that must be addressed first. The way wealthy people think about money is completely different from the way most people do. Average earners see money as something to be spent. They earn it, they enjoy it, and they move on. The middle class, on the other hand, tends to spend money on things that feel like wealth: big homes, new cars, and expensive vacations, but most of these are liabilities. They drain money every month instead of generating it. The wealthy, however, think in terms of assets. They ask one simple question with every financial decision: does this make me money while I sleep, or does it cost me money while I sleep? That single mental shift is the starting point of everything. Warren Buffett is probably the clearest example of this mindset at work.
What we get to add in the way of businesses over time, and we can add them through marketable securities. I mean, we own 5.5% or a little over of Apple. It's probably the best business I know in the world.
He bought his first stock at 11 years old. He didn't grow up chasing luxury. He grew up chasing value. By his mid-20s, he was already obsessively reinvesting every dollar he made. Today, he sits at a net worth well above $100 billion, not because he got lucky, but because he committed to a philosophy early and never deviated from it. The same principle appears in the story of Oprah Winfrey.
Aspects of it in the book that you like, it's giving up control, which is so interesting because the world I did until reading this, you think of a coach as being in control.
She didn't inherit wealth. She built it from nothing by identifying opportunities, creating multiple income streams, and making deliberate decisions about where her money went. Her financial journey is a masterclass in long-term thinking. She once said that she had to stop spending to impress others and start investing to secure herself. The lesson here is straightforward. Wealth is not about how much someone earns. It is about what they do with what they earn, and that behavior is rooted in mindset before anything else. The core formula, how wealth actually compounds over time, now comes the formula itself. It is deceptively simple, but its power is enormous. The formula is this: consistent investment plus time equals wealth. That's it. But unpacking each part of that formula reveals why most people fail to apply it. Consistency is the first pillar. Building wealth is not about one big investment or one perfect financial decision. It is about showing up repeatedly, putting money to work regularly, and never stopping, even when markets get scary. The earlier someone starts, the more powerful the outcome. A person who begins investing at 25 versus 35 has a decade of extra compounding on their side, and that difference can result in hundreds of thousands of dollars by retirement. Compounding is, without question, the most powerful force in personal finance. When returns get reinvested, they earn their own returns. Over time, this creates exponential growth rather than linear growth. Albert Einstein is often credited, though perhaps loosely, with calling compound interest the eighth wonder of the world. Whether or not he actually said it, the math proves the point entirely. The second pillar is diversification. Putting all money into a single investment is not a wealth strategy, it is a gamble. Smart long-term wealth building spreads money across multiple asset classes. Stocks and index funds offer strong long-term growth potential. Bonds provide stability. Real estate generates passive income. A well-balanced portfolio absorbs market shocks without collapsing. Index funds, in particular, have become one of the most respected tools in long-term wealth building. John C. Bogle, the founder of Vanguard,
Added a good bit. People should take an index fund for what it is, Tyler.
championed the idea of low-cost index investing for decades. His argument was simple: most active fund managers don't beat the market over the long run. So instead of trying to pick winners, just own the whole market at minimal cost and let time do the work. That philosophy has helped millions of ordinary investors grow substantial wealth without Wall Street fees eating their returns. The third pillar is debt management. High-interest debt, especially credit card balances, is one of the most destructive forces in a person's financial life. Every dollar paid in interest is a dollar that could have been compounding in an investment account. Eliminating high interest debt aggressively is not just smart, it is essential. Some financial planners suggest treating debt repayment with the same urgency as an emergency. The 50-3-20 budgeting rule provides a practical framework here. 50% of after-tax income goes toward necessities, 30% toward discretionary spending, 20% goes directly towards savings and investments, no exceptions. It is a simple structure that builds discipline without making life feel completely restricted. Jay-Z is a compelling modern example of this formula in action.
Being a person of high integrity, people want to deal with you, in business, in the
Trust.
streets,
He started with almost nothing and eventually built a business empire worth over $1 billion. His wealth came not just from music, but from strategic investments in real estate, alcohol brands, streaming platforms, and sports management. He consistently moved money from income into assets. That is the formula playing out in real time. The habits that sustain wealth for decades. Understanding the formula is one thing, living it out year after year is another. The third piece of the wealth equation is behavioral. It is about the daily and monthly habits that either build or destroy financial progress. The first habit is automation. Wealthy people do not rely on willpower alone to save and invest. They automate contributions to investment accounts so that money moves before there is a chance to spend it. Setting up automatic transfers to a retirement account or brokerage account removes decision fatigue and ensures consistency even during stressful periods. The second habit is continuous financial education. The more someone understands about money, taxes, investments, and markets, the better their decisions become over time. Tax-advantaged accounts like 401s and IRAs, for example, are among the most overlooked tools available to regular earners. Using them efficiently can save tens of thousands of dollars in taxes across a career. The third habit is creating multiple income streams. Relying on a single salary is one of the most fragile financial positions a person can be in. The wealthiest individuals in the world almost never depend on one source of income. They build side businesses, invest in dividend-producing stocks, own rental properties, and create passive income systems that generate money without constant active labor. Rihanna's transformation into a billionaire is one of the most talked about wealth stories of the last decade.
By the way, a friend of mine was at a party this past weekend and he said, "You're excellent at karaoke."
While her music was the foundation, her empire was built on Fenty Beauty and Savage X Fenty, businesses she owned and controlled rather than simply endorsed. She turned her name and influence into equity, which is one of the clearest examples of converting active fame into passive financial assets. The fourth habit, and perhaps the most underestimated, is patience. Long-term wealth is not exciting. It does not produce overnight results. There are years where the market drops, where returns feel invisible, where it seems like nothing is working. The people who stay the course, who do not panic, sell when markets fall, or abandon their strategy when progress feels slow, are the ones who eventually reach financial independence. Every great wealth story has chapters of patience buried inside it. Buffett held Coca-Cola stock through downturns for decades. The reward compounded quietly in the background. That patience was not passive, it was disciplined and intentional. The formula behind long-term wealth is not a secret. It is not locked away in a vault for the ultra-rich. It is a set of principles that anyone with discipline and time can apply. Start with the right mindset. Embrace consistent investing powered by compound growth. Diversify intelligently. Eliminate bad debt. Automate the behaviors that build wealth. Protect it through education and multiple income streams. And then, be patient enough to let time finish the job. The formula has always been available. The only variable is whether someone chooses to follow it.